If you want to see exactly how brutal a sudden macro rate hike can be to a regional bank's engine, look no further than RBB Bancorp's raw Q2 2026 earnings filings.
Oh, absolutely.
Because we're analyzing these raw filings today for this deep dive, Wall Street consensus estimates and, post-market stock reactions aren't provided, but the hard numbers are in.
And they tell quite a story.
Yeah, they really do. So let's just get right into it. RBB reported a net income of $10.1 million. That's a diluted EPS of 59 cents.
Right.
And if you look at that on a year-over-year basis, it's a 13% increase, which sounds phenomenal.
It does.
But yeah, here's the immediate tension in the headline figures. Look at the quarter-over-quarter comparison, and it's actually an 11% drop from Q1.
Yeah, and that quarter-over-quarter dip, that's the thread we have to pull first to understand the current banking landscape.
Right.
When you see a sudden sequential earnings drop like that in regional banking, your first instinct should be to check the margins.
Always check the margins.
Exactly. With RBB, their net interest margin, NI as we usually call it, contracted to 3.06%. So that's a drop of 9 basis points from the first quarter.
Wow. Okay.
And you see a parallel decline in their return on average assets, which slipped down to 0.97% from 1.09%.
Which is significant.
It really is. For a bank carrying $4.3 billion in assets, those basis points represent the core profitability engine just, subtly losing compression.
So let's look at the mechanics of that loss compression by just kind of opening up the income statement.
Let's do it.
Because a bank's business model is basically just a massive arbitrage operation, right? The spread between what they pay to borrow money and what they charge to lend it out.
Right.
So their net interest income for the quarter was $30.1 million. That's down $417,000 from the previous quarter. But the raw data shows that they actually brought in more money.
Yeah, top line was up.
Right. Their interest income went up by $356,000. So the problem is entirely on the cost side. Their interest expense just shot up by $773,000.
Yeah.
The cost of running the machine basically sprinted past the revenue the machine was generating.
And the causality behind both sides of that equation is where the filing gets really interesting.
Walk us through it.
Well, starting with the revenue side, the yield on their average interest-earning assets actually dropped by 5 basis points, settling at 5.81%.
Okay.
But we have to strip out some noise to understand why that happened. In the first quarter, RBB received a $430,000 special dividend from the Federal Home Loan Bank, or FHLB.
Right, because regional banks are required to buy stock in the FHLB to access their liquidity advances.
Exactly. And periodically, the FHLB pays out dividends on that stock based on how the cooperative performs.
Wait, so that FHLB dividend is essentially just a one-time windfall?
Basically, yeah.
So it hits the books in Q1, boosts the yield artificially for those 3 months, and then just vanishes in Q2, making the sequential comparison look worse than the underlying operations actually are.
Precisely. The absence of that specific dividend accounts for a significant portion of the yield drop.
Okay, got it.
However, the true pressure on the margin came from their liabilities. Their average total cost of funds rose 4 basis points to 3.00%.
And what drove that?
Well, the catalyst is incredibly specific. RBB has subordinated notes on their balance sheet. And on April 1st, literally day one of the second quarter, those notes hit a contractual repricing trigger.
Oh, boy.
Yeah. They shifted from a fixed rate of 4.00% to a floating rate of 6.98%.
6.98%. Wait, a nearly 300 basis point jump overnight?
Overnight.
That is severe.
It is severe, and it drove an $829,000 increase in interest expense that was isolated just to those specific notes.
Wow.
The mechanics of these notes are, super common in banking. They're structured as fixed to floating instruments, so they might carry a fixed rate for the first 5 years and then float based on a benchmark rate, like SOFR for the rest of the term.
Right, and when rates were near zero, nobody worried about the floating period.
Exactly. But when that trigger date arrives in a higher for longer environment, the bank absorbs an immediate massive cost increase.
Okay, I want to push back on what this means for the underlying health of the bank, though.
Sure.
If we isolate the math, stripping out the sudden repricing of that subordinated debt to 6.98%, and we remove the one-off FHLB dividend from the Q1 baseline.
Yeah.
Is their core lending engine actually stalling out? Or is this just macro noise temporarily masking, operational stability?
That's the million-dollar question.
Right. Think of it like a manufacturing plant. If you have a long-term supply contract for raw steel that suddenly expires, and you're forced to re-sign at spot market prices, your margins collapse for that quarter.
Right. Your costs spike.
Yeah, but it doesn't mean you're factory forgot how to build cars or that demand for cars dropped.
Yeah.
It just means you took a localized hit on supply costs.
I love that manufacturing analogy because it fits perfectly here. The filings show the factory itself is actually operating exceptionally well.
Okay, how so?
Take a look at their loan interest income. It increased by $725,000 over the quarter. Now, some of that was aided by having one extra day in the second quarter, but it was primarily driven by an increase in their average loan balances.
Okay.
And furthermore, the yield on their average loans only dropped by a single basis point.
Oh, wow.
Yeah, so the core operation of originating loans and collecting profitable interest is entirely intact. That 11% earnings drop was a mechanical, acute event dictated by the terms of that specific subordinated debt contract. It wasn't a systemic failure of their credit model.
Okay, but management can't magically rewrite the contract on their subordinated debt.
No, they can't.
And they certainly cannot control the Federal Reserve's benchmark rates.
Right.
So they're forced to find a lifeline somewhere else, which forces a massive shift in how they source their cash.
Exactly.
And that brings us to the balance sheet moves their deposit mix.
Yeah, the deposit base is the bank's true raw material. Since they were taking a beating on their wholesale debt costs, management aggressively pivoted to control the one funding source they could actually influence.
Everyday depositors.
Exactly, everyday depositors.
And the scale of that pivot is striking. So total deposits grew to $3.4 billion, which is a 6% annualized increase quarter over quarter.
Right.
But the aggregate growth kind of masks the real strategy. They executed a massive rotation beneath the surface. Retail deposits surged by $94.4 million.
That's a huge jump.
It is. And by pulling in that massive wave of retail cash, management had the flexibility to intentionally shed $43.6 million in wholesale deposits. And within that retail growth, demand deposits alone accounted for $64.7 million.
And that distinction between wholesale and retail deposits, I mean, that is the key to understanding regional bank survival right now.
Break that down for us.
Well, wholesale deposits, which are often brokered deposits, they're purely transactional. You are essentially just renting that money from institutional investors or brokerage networks.
Hot money.
Highly rate-sensitive hot money. The moment a competitor bank offers 10 basis points more, that money just leaves your balance sheet.
Oof. Gone.
Right. But retail deposits, particularly demand deposits like standard checking accounts for local businesses or individuals, those are sticky.
Because it's a hassle to move them.
Exactly. The switching costs for a small business to move its payroll and vendor payments to a new bank just to chase a tiny bit of yield, it's way too high.
That structural reality aligns perfectly with the commentary from CEO Johnny Lee in the earnings release. He focused entirely on, quote, improving the quality of our funding base.
And you can see it working.
Yeah, the financial impact of shedding that hot money and replacing it with sticky retail relationships showed up immediately. Even though their overall cost of funds ticked up because of the subordinated debt shock we just talked about, the spot rate for their deposit costs actually went down.
Incredible.
Right. It dropped from 2.79% at the end of Q1 to 2.75% by the end of Q2. So they managed to make their primary raw material cheaper while the rest of the market was facing rising costs.
And we really cannot overstate the importance of that $64.7 million growth in demand deposits.
Because they're free.
Exactly. Those are non-interest-bearing accounts. RBB now holds over $591 million in deposits that cost them literally 0% in interest.
Wow.
That represents 17.5% of their total deposit base. When your blended cost of funds is under pressure, having nearly $600 million sitting on the books for free acts as a massive subsidy for the entire balance sheet.
So for you listening and trying to evaluate the long-term viability of regional banks in this sector, you really have to ask yourself if this specific shift toward non-interest-bearing deposits is the ultimate moat.
It really is.
If a bank can consistently replace expensive flight risk wholesale funding with sticky zero-cost checking accounts, it fundamentally insulates them from the Fed's rate decisions.
It's the ultimate defensive moat on the liability side for sure.
Right.
The challenge, of course, is that gathering retail deposits requires real operational heavy lifting. Marketing, customer service, branch infrastructure.
It's not just a click of a button.
Exactly. It's much harder than just accepting brokered money. But management has clearly proven they can execute that strategy. The other half of the banking equation, however, is what you do with that hard-earned, cheap deposit money.
Right. So let's pivot to where that capital is being deployed and the associated risks. RBB's loan portfolio is heavily concentrated in real estate. Single-family residential, or SFR, accounts for roughly 51% of their loans.
Okay.
And commercial real estate, CRE, sits at about 39%.
And total loans held for investment actually contracted slightly this quarter, dropping by $15.8 million to land at roughly $3.3 billion.
But that wasn't from a lack of lending, right?
No, not at all. That contraction wasn't from a lack of lending activity.
Yeah.
They originated $158.9 million in new loans during the second quarter.
Okay, good.
And the yield on those new originations was a very healthy 6.31%. So they are bringing in highly profitable new assets, but the portfolio shrank overall due to natural paydowns, $50.2 million in loan sales, and a few strategic transfers.
Right. And here is where the filings present a really complex credit quality picture that we need to decipher.
Yeah, this part is tricky.
Looking at the headline risk metrics, they report that non-performing assets, or NPAs, declined 11% to $43.6 million. And more impressively, their non-performing loans, NPLs, plummeted by 47% quarter over quarter, down to $23.8 million.
Massive drop.
Right. If you stop reading there, it sounds like they miraculously cured half their bad debt in 90 days.
But you can never stop reading there.
Right.
You have to trace where those assets went because bad debt doesn't just evaporate.
Okay, so let me push back on this exact point because I'm looking at the OREO line item of real estate owned, and it spiked massively.
It did.
It jumped from $4.3 million at the end of Q1 to $19.8 million by the end of Q2. And the filing notes this increase was primarily driven by a single bad construction loan being transferred.
Correct.
So I'm looking at this, thinking management just slapped a different label on the toxic waste.
That's a fair assumption.
I mean, they moved $15.6 million out of the non-performing loan bucket and dropped it straight into the foreclosed property bucket. So as someone trying to analyze the real risk here, why should I view this as an actual credit improvement rather than just a cosmetic accounting reshuffle?
That is a phenomenal question.
Thanks.
Moving a non-performing loan into OREO means the bank has formally foreclosed and taken legal possession of the underlying collateral, which in this case is the construction project.
Right.
So the toxic waste hasn't disappeared, but the bank's relationship to it has fundamentally changed. They're no longer waiting on a distressed borrower to hopefully make a payment. They now control the asset and can initiate the process of liquidating it to recover their capital.
Okay, but how do we know the asset is actually worth what the loan was?
And that is the key. The reason we know management is in a position of strength regarding this specific transfer comes down to the provision for credit losses.
Explain how that provision mechanic validates their position here.
Well, under current accounting rules, specifically the CECL standard, current expected credit losses, banks have to proactively reserve for expected losses over the entire life of a loan.
Okay.
So if foreclosing on that construction project was going to result in a material loss for RBB, meaning the value of the property was significantly less than the loan amount, they would have been forced to record a massive provision expense this quarter to cover the shortfall.
Got it.
And that provision would have flowed directly through the income statement and crushed their earnings.
But they didn't record a massive provision.
No, I didn't.
The filing shows a provision for loan losses of $77,000, which was completely neutralized by a negative provision, a reversal for unfunded loan commitments of exactly $77,000. So the net impact on the income statement was zero.
Yeah, the reversal on the unfunded commitments is a key detail.
Why is that?
Because in construction lending, the bank agrees to a total loan amount but only funds it in phases as the building is completed. So when they foreclosed on the project, they were legally released from having to fund the remainder of the loan. That allowed them to reverse the reserve they had set aside for those Fincher unfunded amounts.
That makes sense.
More importantly, the fact that the net provision was zero tells you management believes the underlying real estate they just seized is valuable enough to cover the outstanding principal.
Okay, and we see that confidence reflected in their actual losses, too.
Yeah.
The net charge-offs for the entire quarter, the loans they formally admitted were completely uncollectible and wrote down to zero, were a minuscule $83,000.
Tiny.
Yeah. That represents 0.01% of their average loans on an annualized basis.
So when you combine virtually zero net charge-offs with zero net provisioning, it signals a highly controlled resolution of a problem asset. They are operating with a robust safety net.
Yeah.
Their allowance for loan losses currently sits at $43.7 million. That represents 1.32% of their total loans held for investment. Because they successfully removed that large construction loan from the non-performing category, that $43.7 million allowance now covers an overwhelming 183.76% of their remaining non-performing loans.
Wow.
Yeah, the credit profile is stabilized, the reserves are deep, and they are not projecting severe macroeconomic deterioration that would require them to hoard more capital.
And that defensive posturing naturally leads to the next phase of the bank's strategy. When management successfully controls funding costs via retail deposits and neutralizes credit risks with heavy reserves, the bank naturally begins to accumulate excess capital.
Right, they can start playing offense.
Exactly. The filings show they're aggressively pivoting to go on the offensive with that capital to reward shareholders.
Right.
So let's look at the return metrics.
Let's do it.
They declared a $0.16 quarterly dividend. Over the trailing 12 months, they've returned $28.0 million to stockholders through a combination of dividends and share repurchases. And additionally, they just authorized a brand new repurchase plan to buy back up to 1 million shares between now and June 2028.
And regulators monitor stock buybacks very closely. A bank cannot aggressively repurchase its own shares unless it has a massive buffer of capital to protect depositors against unforeseen shocks.
Right.
We evaluate that buffer using the Common Equity Tier 1 Capital Ratio, or CET1. This metric measures the core equity capital of the bank against its total risk-weighted assets. A standard regulatory requirement for a bank to be considered well-capitalized is typically around 6.5%.
Okay, so where is RBB?
RBB's CET1 ratio currently sits at an astounding 18.00%.
Wow, 18%.
Yeah, they are operating with a fortress balance sheet, giving them total flexibility to reduce their share count.
Let's break down why reducing that share count is so accretive for the investors who actually hold on to the stock.
Sure.
The primary metric for valuing a bank's fundamental worth is tangible book value per share. This is the calculation of what would be left for shareholders if the bank liquidated all its hard assets and paid off all its liabilities, excluding intangible items like goodwill. So RBB's tangible book value per share increased to $27.23, representing an 8% increase year over year.
And the mechanics of how buybacks interact with tangible book value are crucial here.
Go on.
If a bank's stock is trading in the open market at a price lower than its tangible book value, which is super common for regional banks in this high-rate environment, every single share the bank repurchases and retires automatically increases the tangible book value for the remaining shares.
Because you're slicing the pie into fewer pieces.
Mathematically, yes, you're concentrating the hard net assets of the company among a smaller pool of owners. It's a highly efficient mechanism for creating shareholder wealth.
Okay, so as we look at the operational metrics tying all this together, there is a quirk in the efficiency ratio that really warrants explanation.
Ah, yes.
Their efficiency ratio ticked up to 57.46%, compared to 55.41% in the first quarter. Now, in banking, the efficiency ratio measures how much it costs to generate $1 of revenue.
Right.
So a higher percentage means the bank is operating less efficiently. On the surface, that looks like a negative trend.
It looks negative until you isolate the variables in the math. The efficiency ratio is calculated by dividing non-interest expenses by net revenue.
Okay.
The numerator, their actual operating expenses, did not go up. In fact, management actively cut costs, driving non-interest expenses down by $236,000 to a total of $19.0 million.
Oh, wow.
Yeah, primarily through reduced payroll taxes and tighter operational controls.
So the deterioration in the ratio was entirely a revenue problem.
Exactly.
The denominator shrank because of the specific margin pressures we discussed at the very beginning.
Right.
You know, the $829,000 hit from the subordinated debt repricing and the absence of the $430,000 FHLB dividend.
Right.
So the efficiency ratio went up not because management got sloppy with expenses, but because top-line revenue was temporarily compressed by a macroeconomic shock.
The entire earnings report connects back to that central tension.
Right.
The margin compression at the top of the income statement flows all the way down to the efficiency ratio, despite management actively cutting operating costs. Yet, because they have built that fortress 18% CET1 capital position and maintained exceptional credit metrics through strategic foreclosures and deep reserves, they have the financial stamina to absorb that temporary margin pressure without sacrificing their long-term strategy of returning capital to shareholders.
Right. So we've unpacked an incredibly dense and nuanced quarter for RBB Bancorp here, highlighting how management is navigating a punishing rate environment by shifting to non-interest-bearing deposits and strictly controlling credit risk.
It's been a busy quarter for them.
But there is one final forward-looking detail buried in these filings that you really need to monitor as we move into the next quarter.
Oh, this is a big one.
Remember those painful subordinated notes that triggered on April 1st, jumping from 4.00% to 6.98%?
The notes responsible for almost the entirety of the interest expense explosion this quarter.
Exactly. On July 1st, the day after this Q2 reporting period officially closed, RBB redeemed $40 million of those specific 6.98% subordinated notes, paying them off entirely.
Huge move.
So your challenge, as you analyze this bank moving forward, is to calculate how much immediate margin relief that single $40 million debt retirement will generate for their net interest income in Q3.
Something to watch very closely.
Follow the show for daily earnings coverage.